This is level 2 of the CFA program, the topic on equity valuation and the reading on return concepts. This reading sounds like it ought to be maybe one page and maybe one learning outcome statement. You can agree with me that if you start with a financial security whose initial value is 100 and you end up with a value of 110, that's a 10% return, and that ought to be the entire reading. However, what's important, and you'll see this when we look at the LOSs here in just a second, is that we need to kind of decompartmentalize that 10%. Remember, that 10%, that could be the return on an equity investment or a fixed income investment or some alternative investment like movie memorabilia. And so as we look through these LOSs, you'll see the intensity of the decompartmentalization. How's that for a good word to start off the slide deck? So look what we're going to do. There is a handful of calculates in there, but a lot of them are just, let's figure out what all of these different kind of returns mean. How do we compute them? And then let's look at some really cool models that some really smart individuals have come up with over the years. Of course, somewhere in the middle there, we'll have to talk about beta. We can't talk about return without talking about risk. And then we'll end with a really quick couple of slides on the weighted average cost of capital. So let's look at just a quick recap about return concepts. What we're trying to do is evaluate expected performance, right, ex ante, looking to the future, and past performance, looking at history. And one way to do that, in fact, one really, really good way to do that is to understand the risk premiums. And to understand risk premiums, you have to start at a financial security in which there is no risk. And of course, the standard proxy for a risk-free security is a yield on a U.S. Treasury security. So we start with that, say that has absolutely no default risk, and then we have to add premiums. Maybe there's a premium for liquidity, maybe there's a premium for risk, maybe there's a premium for something else out there. We'll investigate that concept of a premium in some slides that we have for you today. And then what we do is we take those risk premiums and then we try to figure out, okay, what's a reasonable interest rate or a discount rate to estimate value. All right, if you look at that first LOS, there are a whole bunch of returns that they want us to identify and define and distinguish among. So let's start with simplest of all, holding period return. This goes back to my initial example in that very first slide. What did I say? We started out with 100, we ended up with 110. And so I always teach my students just to do a quick F over P minus 1. 110 minus 100. I'm sorry, 110 divided by 100 minus 1, that gives us that 10%. However, there's lots of times where there is an interim payment between the purchase of the asset at 100 and the selling of it for 110. All you really do is add that payment. So look at this kind of a holding period return equation that comes right out of the reading. It has two components. It has investment income. So that D, that could be a dividend. It could be an interest payment. It could be some other payment that, is specific to a unique contract divided by the price. So there's, kind of some kind of a yield, right? Investment income is what the reading calls it. And then we add the price appreciation or the capital gain. And that's kind of like the F over P minus 1. So look at that formula over there on the other side of the equal sign. You really just take the F over P minus 1 and you just add any of those interim payments there. So for example, what was my example? If I started with 100, ended up with 110, but I got a dividend payment of $8 somewhere in there, then my return would be 118 over 100 minus 1. That would give me 18%. Now, the typical convention is to make certain that the 100 is today and the 110 is 1 year from today. If it's some other than 1 year in between, then you have to do some kind of adjusting and over the compounding for that time period to turn it into an annual holding period return. All right, let's continue in the distinguished here. So realized holding period return. So that's just what happened in the past. Expected holding period return. That's just what we expect to happen in the future. And then this concept of required return, this is how I explain it to my students. I always say to them, remember when your parents or your grandparents or aunts or uncles, whoever raised you, dropped you off your very first day as a freshman in college, and they inevitably wagged their fingers at you. They said something like, you know what, you should study hard and have good friends and get good grades and graduate on time and then get a good job. That's like the required return. That's their expectations for your individual behavior. And so this is the exact same way that investors ought to look at parting with their hard-earned capital. They say something like, okay, to an executive at a corporation, or they say, okay, to a government official at some municipality or a federal government acting as a borrower. They say, look, if you want my money, you better, required return, you better, pay me a dividend or pay me regular interest, and I want a capital gain as well. So I want you to think of that as, wagging the finger, because those borrowers, they need our capital, right? So we have the right to demand something out of it. Well, that's what we require. A couple of things inside of this required return. Of course, if we have a required return that is, let's say, 10%, and our expected return is something greater, then we might want to say something like, hey, that asset probably is overvalued. Or if the opposite holds true, maybe we want to say that it's undervalued. But look at that. What is that? The third circle point there at the bottom. The expected alpha is equal to 0 when the expected return minus the required return equals 0. That's when an asset is efficiently priced. So you wipe out the probability of overvaluation or undervaluation. How about a price convergence, right? If the expected return and the required return are not the same number, there's probably going to be a convergence to the intrinsic value. And, you can come up with a regular little old equation that we have in that purple box at the bottom. The important concept here is that once those prices move away from their intrinsic values, whether they're overvalued or undervalued, is that sooner or later enough people are going to come up with a more and more accurate estimate of that intrinsic value, and that's going to dictate their behavior over in the capital markets. And so they're either going to bid up or bid down the price of that share of stock or that bond, so it moves to its intrinsic value. So just think about it this way. Forget about Eugene Fama just for a second. Don't ever quote me saying forget about Gene Fama. Forget about Gene Fama and the efficient markets hypothesis just for a second and say that prices can move way up or way down away from their intrinsic value in capital markets. Well, think about that there's going to be an information search, right? All of these investors who believe it's undervalued or overvalued are going to search for information to know when it stops being under or overvalued. And so that must mean that there's lots of activity on the floor of the New York Stock Exchange, and there's going to be a convergence to intrinsic value. So that's the important concept for the reading. What the reading doesn't really address, and this is quite a difficult task, is to when does that convergence occur? I mean, if you could say, hey, that convergence is going to occur next Thursday, well, then if you were accurate most of the time, then you could turn yourself into not only a millionaire, but a billionaire. And of course, you wouldn't do it on the floor of the New York Stock Exchange. You'd go over to the derivative markets and make your millions or billions there. This concept of a discount rate, of course, you remember this not just from level 1, but from your undergraduate days. We use this term discount rate as the interest rate that is used to compute the present value of those future cash flows, to compute intrinsic value. And that discount rate is not just some number that we pull out of the atmosphere. No, we have to have some kind of a model that reflects boy, how about if I just use the word uncertainty? The reading wants you to talk about risk, and that's true, of course, but you need a discount rate that reflects the uncertainty surrounding the timing and the magnitude of those future cash flows in relationship to the promises that are made by all of the borrowers. But if you look in the reading, notice that second orange arrow point. That discount rate is going to be equal to the risk-free rate. Of course, that's a beginning point for lots and lots of models, but it's going to add the required compensation for the risk associated with those cash flows. And so this should make perfect sense that if you buy some type of a corporate bond, let's say it's an investment grade corporate bond, you can assign some kind of a risk level to those cash flows. And if it's investment grade, let's say it's a AA rated bond, maybe the risk is about this much, right? So your discount rate is going to be some number to reflect that magnitude. But if it's an equity security and those dividend payments, remember, they're not contractual, they're not guaranteed. Maybe the risk is this much. So you're going to have a higher discount rate. Let's go ahead and move on to this concept of an internal rate of return. An internal rate of return it's a discount rate, of course, and it is the discount rate. It's not just a discount rate, it's the discount rate that turns the present value of all of those future cash flows into the price of that financial security. And what the what the reading does for you is use our favorite Gordon growth model. Look at the D1 over KE minus G. It uses that Gordon growth model to illustrate the concept of an internal rate of return. And you can use IRR for lots of models, like for bond pricing and for swap pricing and for options pricing. You can do all that in there. But the important point is that first arrow that equates the present value of the future cash flows to the asset's price. Now look at that second orange arrow point. If the internal rate of return is equal to the required return, then markets are efficient. So let me swing back and say, all right, it's time to remember Eugene Fama and all of those important founders of modern portfolio theory that taught us a tremendous amount about efficiency and what it means. And this is a really good illustration of how to apply those efficiency concepts into this LOS, which tells us that we should distinguish among all that kind of stuff. All right, moving on to this concept of an equity risk premium. This is super cool stuff. So all we're saying here is that we need some kind of a discount rate. We need some kind of an interest rate. We can look at it from historical perspective, or we can make some estimates based on interest rate paths or dividend paths. We call that forward-looking estimates. And so all we're going to do is take that risk-free rate today and then add an equity risk premium. So that's really our task here in the next handful of slides, is to figure out how we can compute or estimate with some degree of accuracy that equity risk premium. And then, of course, on the right-hand side of the equal sign, that's going to give us our required return on equity. Now, what we can do is we can go ahead and turn our head to the left and say, okay, let's see what's figured out. Let's figure out what's going on in the past, and let's use this as an historical estimate. So let's choose an equity index, right? Hey, can I go out on a limb and say S&P 500 index? But any index is probably okay. Choose a time period, right? And I've told you many times that when I wrote my dissertation, I used a 3-year window, and I looked at daily stock returns. I mean, my data set was huge, but 3 years, maybe that's the right period. Maybe 1 year is the right period. Maybe 5 years is the right period. So choosing a time period is a pretty critical part of this historical estimate process. And remember that the ultimate equity risk premium is going to depend on the choice of the index and the choice of the time period. And so then you can compute the mean return on that index. And then, of course, the proxy for the risk-free rate, almost universally, is the U.S. Treasury security yield, although the reading does mention the German federal bond yield as well. All right, a couple of things that I just addressed in that recent slide. All right, issues in using historical equity risk premium estimates. Okay, so longer time period is better, and I think that's pretty accurate. 3 years is probably better than 2 years. However, if you go back 20 years, is 20 years better than 5 years? I mean, a lot happens in 20 years, so 5 years is probably sufficient. Remember the difference between geometric and arithmetic means. I'm almost 100% positive that I went through a good example back in level 1 on this one. Geometric mean reflects future values more accurately, and that's because it takes into consideration of compounding. So just remember that. I mean, if you ever got to that on an exam, arithmetic mean ignores compounding, geometric mean considers it. And by the way, did I say this a few moments ago? Internal rate of return is a geometric return as well. All right, choice of the risk-free return. Yeah, general preference for a long-term government bond yield. All right, I just mentioned that. Survivorship bias. This is really an interesting concept that I learned back in graduate school. You collect a sample and you think, okay, here's a sample of, whatever I'm trying to study, and it's a pretty good sample. And in fact, I think it's an excellent sample. But there are firms that have gone bankrupt, or have been taken over, or who have had equity carve-outs, or all these kind of things that are no longer a part of that flow, and they should be included in that sample, but they're not because they didn't survive whatever event that was. So look at the issues here, right? Using returns from surviving firms artificially inflates the estimates of return. So that's probably a really good final question on a vignette where you're asked to do a bunch of stuff, and then some character in the vignette is going to make a comment, and they'll make a comment about, hey, you know what, we didn't include these two firms because they declared bankruptcy right in the period before we collected our sample. What's the problem? And you just jump all over that. You say survivorship bias. And then when you look at history, think about what we had in 2020 and 2021. Think about COVID and how that impacted stock prices and bond prices and all sorts of asset prices. And so you got this negative event that dominates over that time period. Well, does that mean if you use that time period in your sample to estimate the equity risk premium, going forward, then, if you use that historical estimate, then you're going to expect to have another kind of a COVID similar event. So make sure when you use this historical estimate that you're aware of all the positivity and negativity that went on during that sample period. All right, forward-looking estimates. We're going to use current information about the macroeconomy, and we're going to use current information about financial statements of an individual company, right? So we take all that current information and then we take a sit back and we say, all right, based on all of this current information, and by the way, can you guys see my arms? It's a huge data set. And then we're going to say, based on this current information, what can we expect to happen over the next year? So current plus the expectations to form that forward-looking estimate. And so this is where financial analysis is such a thing of beauty, because you use lots of technical stuff, right? Math, regressions, copulas, all this good stuff. And then you use your brain and maybe your heart and soul, and you use a broad brush, and then you use some fine brushes for the artistry, that you layer the technical aspects of all of this with an artistry, which of course is based on things like experience and, this never happened before, but we expect it to happen again, et cetera, et cetera. So this forward-looking estimate is really a combination of art and science. But look at that second arrow point. This is what I was saying about, do I want to include my heart and soul in this? Subject to potential errors like modeling errors. So we could make some math or technical mistakes in putting together together our model, or we could have some behavioral biases. Remember, behavioral biases come in two forms. They come in the forms up here, hello McFly, what are you doing up here, McFly? We call those cognitive errors. So we make all these mental mistakes, and most of them are the result of, we just really don't have the time. We're going to take a shortcut, right? It's called a heuristic. But then we have the errors of emotional biases, right? Oh, my grandmother loved me so much, and on her deathbed, she said, here, Jimmy, here's 100 shares of Harley Davidson stock. Please don't ever sell it as long as you're alive. So you say, okay, Grandma, I love you too. But now you have these 100 shares of stock in Harley Davidson, and maybe it's a great stock. Maybe it's appropriate for your portfolio. But then again, maybe it's not. But you made a promise to your grandmother, and you can't go back on it. So you have these emotional attachments and emotional biases that are mostly of the heart. So that's a really, really great exam question. If I were combining LOSs from one reading to another, I would absolutely put that behavioral bias in there. All right, how about if we use our favorite Gordon growth model here? So what we can look at are these broad equity indexes. They are associated with a dividend yield, right? You can compute that dividend yield, and look at that last part of the first circle point. Year ahead dividends are, boy, and this comes right out of the reading, fairly predictable. Not perfectly predictable, but if you look at companies like Johnson & Johnson and Coca-Cola, they pay a dividend and it's pretty much extremely stable regardless of what's happening with COVID or what's happening with international conflicts or what's happening with the local economies. Those dividends are fairly predictable, not perfectly predictable. So make sure you don't fall into that trap on an exam question. And so all we're going to do is to determine the equity risk premium based on dividend yields and based on growth rates. And that G in that equation, of course, that's closely tied to the growth rate in dividends. Maybe you could interpret it as the growth rate in earnings. But here you can use this as the global growth rate in earnings or dividends. Now, for some companies, that growth rate it might be the same, but it's probably not going to be the same. And then we need to take out the yield on those long-term government securities. So let's take a look at just a super quick example. And this will address the LOS to calculate using historical art. So you ready for this? And the forward-looking estimates. So there's our dividend yield. There's our growth of 8. There's the government bond yield of 6%. So this is really just a matter of using, a fairly high level model, but all we're doing is going back to kindergarten and we're taking the apples and adding some apples and subtracting apples. So 2 and 8 minus 6 gives us a 4% equity risk premium based on the Gordon growth model. Now, of course, I've mentioned a few times, this global economy, this macroeconomic variables. So you would suspect there's got to be a model that looks at really super important things like inflation, right? So this macroeconomic model is really an estimate of what happens to the equity risk premium on the floor of the New York Stock Exchange in the context of these macroeconomic variables. All right, and so notice that we have expected inflation, we have expected growth rate in real earnings per share. Notice we put the word real in bolded green font so that you don't fall into that trap on the exam. That in this model, those are real earnings per share, which makes sense because if we have inflation in the first part of the model, then we have to not consider it again in the second or the third part of the model. And then we have expected growth in PE ratios and then an income component and then the risk-free rate of interest. And so notice those first three, it's 1 plus, 1 plus, 1 plus. So there's the compounding. There's the nature of kind of an internal rate of return or a geometric return. So we're going to do 1 plus, 1 plus, 1 plus, and multiply those. And then we're going to subtract 1. Then we're going to add the expected income component. And then we're going to subtract out that risk-free rate of interest. So let's take a look at just another quick example here. And so notice what we do in the middle, expected growth in the PE ratio, there's a 0%. So we threw that 0% in there just so that you don't think, oh, 0, let me multiply that and move that all the way through and cancel out everything on the left-hand side. No, it's 1 plus 0, so notice we have 1.03, 1.04, 1 minus 1, and then there's the 3.8, subtract out that 6. So there's the equity risk premium using this macroeconomic model. Moving on to the next LOS, notice this one asks us to estimate the required return on equity using, boy, a bunch of different models. So what we've been doing here in the past, let me just go back real quickly. Here's an equity risk premium. Here's an equity risk premium. And what we're doing now is we're going to use that equity risk premium plus some other things, plus some other input variables to estimate the required return on equity. And clearly this begins those of you who've been paying attention to my recordings over the years will know that capital asset pricing model is, of course, one of my favorite models. So this is really cool stuff. All right, you ready for this? Capital asset pricing model developed in 1964 by a dude named William Sharpe, among others. But William Sharpe said the following. He said, let's go ahead and try to figure out what is a reasonable required return on equity on a company like Coca-Cola. And William Sharpe said something like, well, let's begin with the risk-free rate of interest because nobody would lend money in the equity markets to Coca-Cola executives if they were going to earn less than the risk-free rate of interest. That's just pure common sense. So William Sharpe was the first one to begin with the risk-free rate of interest. And then notice in the equation, there's a plus sign. And what are we adding? Well, we're adding this equity risk premium that we just calculated over the last couple of slides. So notice that we have in green bold in that top equation, the equity risk premium, and then scooch down to the next one here. How do we define that in this example in the capital asset pricing model? We take the expected return on the market portfolio. And this is what I tell my students. I say, look, let's suppose that you owned one share of stock of every stock that trades on all of the exchanges all throughout the world. Well, whatever you expect to earn on that portfolio, that's the expected return on the market portfolio. Now, that's not a perfect analogy. It's not a perfect example, but it gives students, kind of an idea of the magnitude of the breadth of what this market portfolio means. And then, of course, we have to subtract out the risk-free rate to get the equity risk premium. So this is the genius of William Sharpe. He said something like, okay, we're going to start with the risk-free rate. We're going to add an equity risk premium, but then we're going to weight it by its level of systematic risk. You guys remember this. Beta is a measure of systematic risk. What does that mean? Systematic risk, variability in stock returns due to changes in economic variables, things like inflation, things like interest rates, things like exchange rates, things like COVID, right? Things like anything that occurs inside of that macroeconomic environment. Remember that betas are standardized random variables, but in general, most people think of them as being between 0 and 2, and that's probably an okay way to think of it. And so if you have high beta stocks, you have stocks that are super sensitive to changes in economic information. If you have low beta stocks, then you have stocks that kind of yawn. Do you remember that old Steve Martin line where he says, get all excited and go to a yawning festival? Well, that's exactly what Steve Martin meant on the floor of the New York Stock Exchange, that low beta stocks, they react to changes in economic information, but they are very insensitive, right? They don't react very strongly. And so here's the cool thing about forming portfolios is that, of course, we're going to use diversification, but then investors get to pick their level of systematic risk. If they want to be super sensitive, then they pick high beta stocks. If they want to be low sensitivity, then they pick low beta stocks. Of course, the illustration there is a picture of the security market line, which is a graphical illustration of the capital asset pricing model. Notice beta is over there on the horizontal axis. return is on the vertical axis. There's the security market line. There's the beta of 1. There's the expected return on the market portfolio, et cetera, et cetera. Let's go ahead and take a look at a super quick example here. We're given some input variables, and we go ahead and calculate this required return on equity. And so all you're doing is putting those inputs into the equation. And by the way, let me get out my calculator. I love showing you guys my calculator because it's 100 years old. Remember that if you're using this 12C, you can't do the 5 and then enter and then the 1.10. Do inside the brackets first. So just do me a favor. Don't miss this on the exam because you violated the distributive property of mathematics. So do the 10 minus 5, right? That gets you 5. And then multiply the 1.1, so that gets you 5.5. And then add the 5, and that gets you the 10.5. Apologies to those of you who don't need to be reminded not to violate the distributive property of mathematics. Now, notice that we put the beta there, the measure of systematic risk, in green. Now, I want to tell you a little story about my history in learning this capital asset pricing model. I was fascinated by this in my PhD level classes, and my professor was saying that beta has a great ability to capture. Let's go back and do this again, right? What is systematic risk? It's variability in returns due to changes in economic factors. So how many economic factors are there? Well, you could probably list 10 important ones, but then you could probably list 90 sub-important ones, and then maybe another 1,000 just less than important ones. So beta has a lot of pressure on it to capture the sensitivity of one stock to changes in all of that economic information. For example, this is what I tell my students. Let's suppose you wake up one day and you get good news about inflation. Okay, so that's going to affect the beta of this particular stock and its required return. But then let's suppose the next day you get up and there's good information about just interest rates in general. And so that's going to impact the required return on equity for that particular firm in a manner. But are they identical? My point is that beta in the capital asset pricing model has tons and tons of pressure on it to capture all of those inputs and summarize it in one measure of sensitivity. So that's why we came up with this Eugene Fama and Ken French model, in which these two super talented individuals said something like, all right, we believe in the capital asset pricing model. We like it. But we also know that there is way too much pressure for beta in the capital asset pricing model to capture some size and some value variables. So that's all this Fama French model is. It's a multi-factor model, right? CAPM is let me go back here. It's a one-factor model, right? Here, this is a multi-factor model in which we're adding size and we're adding value. And so we still are solving for the expected return on an individual stock over on the left-hand side of the equal sign. We're still starting with the risk-free rate of interest. We're still putting CAPM in there, right? But then we're adding size and value. And the Fama French model has been super helpful in identifying and estimating the required return on equity. Some researchers say it does a way, way better job than the capital asset pricing model. That's not really part of this reading, so I wouldn't worry about this. Let's go ahead and look at a quick example. All right, so we're given risk-free rate, we're given premiums, we're giving now betas. All right, so notice that first beta. So that's the equity beta that we know and love from a long, long time ago. But now we have another beta, a size beta and a value beta. So here, let me just go back here quickly. So we have a beta SMB and a beta HML and a beta MKT. Now remember, beta is a measure. It's a standardized variable, so it's covariance over variance, and so that notation there is just the numerator part of that. So here's our required return based on the Fama French model. And all we're going to do is we're going to start with the risk-free rate and then pair the premiums or premia with its individual beta. So if you do the math, you get, what is that, about 16, a little more than 16%. So the question then becomes, now, this is me. This is Jim the professor. The question then becomes, all right, which one do we like? Do we like this one better? Do we like this one better? And that's an empirical issue. And there are tons and tons of academic research out there that try to make a distinction. But clearly, the Fama French model as a multi-factor model, and then, boy, dare I even say, leading into the arbitrage pricing model, et cetera, et cetera. All right, how about the Pasteur-Stambaugh model, in which these two talented individuals say something like, hey, we love capital asset pricing model, we like the FF model, but all stocks are not created equally from a liquidity standpoint. Some stocks like Coca-Cola and Johnson & Johnson, you can go to the floor of the New York Stock Exchange and you can buy or sell these things anywhere, right? There are people trading these over there. They're trading them over there. They're trading them in the restrooms. They're trading them over by the cafeteria. They're trading them out in the street, right? There's no problem with liquidity of these super popular stocks, right? Stocks with the brand names. But what about a company over here? You guys remember in a previous recording, who was I? Jim's Soap Company or Jim's Bakery, right? Jim's Bakery. Maybe, Coca-Cola is this big and Jim's Bakery is this big. Well, I might have a liquidity issue. And so, of course, investors are going to demand compensation for buying my stock because when they go to sell it, they may not be able to find a buyer quickly and who's willing to pay a market price, right? For Coca-Cola, you can always find someone willing to buy, someone willing to sell. But for Jim's Soap Company, maybe not. So all we do is the same thing that we did for the FF model. We just add another measure of sensitivity, and that's for liquidity. And so remember now that the orange there on the far right, that's probably going to be 0 for Coca-Cola. All right, how about moving on to macroeconomic multi-factor models? Okay, here we go. Let's use factors related to economic variables that would impact the cash flows or the discount rates of the company. Oh my gosh, I have to be so excited to read that and read it to you, right? What did we learn back in our Modigliani and Miller days? What did those two superstars teach us? That the value of a company is based on the quality of the assets. What does that mean? The ability of those product lines to generate cash flows. And it's a function of the weighted average cost of capital, which is a particular discount rate. So this model here comes right out of Modigliani and Miller in 1958. Let's find macroeconomic variables that are going to impact cash flows or discount rates. And this was developed by Burmeister, Roll, and Ross. That's Ross of the APT. That's Roll of the what is really the true market portfolio. But anyway, look down the right-hand side on inside of the parentheses. Confidence, time horizon, inflation, business cycle, and market timing. All right, so we have 5 macroeconomic factors, right? So this is a multi-factor model. It's a multi-factor macroeconomic model because we're looking at things that are super important to the economy. And so if all of these things, are you ready for this? If all of these 5 variables are improving, right? Well, that probably means that the economy is expanding. Well, then that required return on an individual stock or a portfolio of stocks is probably going to reflect that increase in all of those variables. So let's take a look at some more specific examples inside of each one of these. So confidence risk. I mean, this really says something like, okay, if investors had absolutely no confidence in the equity market, then what would they do? They would just absolutely flood to government bonds. But if they had total confidence in equity markets, what would they do? They would flood to the New York Stock Exchange, bidding up all the prices and then lowering the yield. So that confidence risk is the unexpected change in the difference between the return on risky corporate bonds and government bonds. I did say New York Stock Exchange just a second ago. I should have said the New York Bond Exchange. Time horizon, of course, what do we know? We know that interest rate risk is higher for longer term bonds, which means that time horizon risk has to have something in that inside of its definition. Unexpected change in the difference between the return on long-term government bonds and treasury bills. That's a time horizon risk. So sometimes we may not care if we own a 50-year or a 100-year bond, but sometimes we might, right? Inflation risk, that's probably a pretty obvious notion. Business cycle risks, probably the same as well. Real business activity. What do we know about business activity? Up and down and up and down. But what's key here is that unexpected change in that level. And then market timing risk is one of those plug numbers that says something like, all right, so we can explain lots and lots of stuff up here, but whatever we can't explain, we're just going to throw into this market timing. And of course, we have lots and lots of traders out there who are trying to time the market, whether they're technicians or fundamental analysts. Timing of the market is a goal for lots of people. All right, let's go ahead and take a look at a quick example. So we're given some confidence risk, time horizon risk. We're given all those risks. And then notice that last circle point there. The sensitivities for the stock are 0.2 minus 0.3, et cetera, et cetera. So 2% risk-free rate of interest. The required rate of return is closest to. So you just lump all those together, do the math, and you get 11.45%. Now we're here at this last one. Boy, this LOS has taken us a while, right? So the build-up method. The build-up method, it can be used for any company, but it's most likely used for companies that are either closely held or maybe they're even private companies. And it's really difficult to estimate those betas with any type of accuracy. So all we're going to do is the same thing that we did before, right? We're going to start with a risk-free rate, and then we're going to add some premiums, right? An equity risk premium, a size premium, and a company-specific premium. What we're going to try to do is we're going to try to find a company out there that looks an awful lot like our company, and then we're going to use that. So look at the very bottom gray box. Yield to maturity on the company's long-term debt plus a risk premium. So let's just do a super quick example. So we have a 20-year bond, yield to maturity of 5%. Risk premium of 4% is applied. So here we're not really coming up with this model at all in terms of where did we get that 4%. But you can imagine that we got that 4% as kind of a combination of all of the things that we've talked about over the previous, 8 slides or so. So here we're just going to take 5 and 4 and add those together to get 9%. So that cost of equity is a function of, and this is important here, it's a function of what's going on with our bonds and then what's going on with the company's equity that looks like the company's equity from somebody else who may perhaps have lots and lots of trading. All right, how do we estimate beta? Boy, this is a super easy thing to do, even in Excel. You can estimate the beta for Coca-Cola in about 1 minute. If you go to Yahoo Finance, you download monthly stock prices, download those into an Excel spreadsheet. That takes about 8 seconds. Then download the same time period of the S&P 500 index into that same Excel spreadsheet, and then hit the regression function in Excel, and you get the beta. And it's that easy. So beta is estimated by regressing the returns on a company's stock on the returns of the overall market. I just used Coca-Cola in the S&P 500. The index has to be something that's relevant, right? You wouldn't want to use the S&P 500 index if I'm Jim's Soap Company. Jim's Soap Company is not a part of the S&P 500 index. Jim's Soap Company doesn't look like anything that any of those companies inside of the S&P 500 index look like. So we'll probably have to pick another index, and maybe it would be an index like the index of small companies run by people that look just like Jim and people that have the same technical expertise as Jim, whatever that means. Length and frequency. The reading says 5 years of monthly data is most common, and that's probably true. I don't know if it's the best, but leave my editorialization out of your answers. Here we go. Adjusted beta for public companies. This is really a cool concept here. What do we know about betas over time? There are tons and tons of problems with beta because they're not stable, right? There are many academic journal articles that are called the instability of beta. And that just means that beta changes over time. The sensitivity changes over time. So there's probably going to be some drift, but there's also a tendency, since the average is 1, right, that high beta stocks are probably going to converge to 1. Low beta stocks are probably going to converge, downverge, and upverge. Are those words? I don't think they are, but you understood what they meant when I used them in a sentence. And so you have this reversion to the mean, which we know is absolutely holds true with many variables, and beta is not an exception. And so here's the adjusted beta using the Bloom adjustment. All we're going to do is attach 2/3 weight to the regression beta and then 1/3 weight to the average beta to get our adjusted beta. So this LOS just asks us to explain the beta estimation, right? And I just did that for you, but it's probably not too much of a task for you to remember 2/3 and 1/3 for Bloom if you have to compute it on the exam. How about a pure play method? Yeah, we saw this back in level 1. Estimate the beta of a company that is not publicly traded. So once again, we're going to get this comparable publicly listed company. So what does comparable mean? Well, I've said this in multiple recordings recently. Comparable company means something like, boy, it has the same size, maybe revenues or maybe assets, right? Or maybe bond issues, or it has the same risk. Maybe it has bonds that are traded. Maybe they have the same yield. Maybe they have the same rating. I mean, there are all different ways to try to find a comparable publicly listed company to use as kind of our benchmark. So here's the process. So we identify this one, which is not an easy step, but then we're going to estimate the beta of that company, just like I described to you a moment ago, simple using Yahoo Finance and Excel. But then what we need to do is we need to de-lever, but the reading uses the concept of unlever. So we're going to take that beta and we're going to strip away any debt that it has in its capital structure. And so we use that equation right there. So it's the reciprocal of 1 plus the debt over the equity ratio. All right, so that strips away the effects of capital structure on this comparable company. And then if we de-lever, then we re-lever. See, I get that notation, that terminology from watching too many episodes of Seinfeld. So we're going to re-level the beta using the capital structure from our thinly traded company or our non-public company. And so there's the 1 plus the debt equity ratio. We've seen that many, many times, not least of which is in the Modigliani and Miller articles. Boy, this is a really good summary slide that we put together. I'm in favor of you getting out your phone and taking a picture of this. So you have, so far in level 2, what have I told you to take 10 pictures of slides? So you should have those in a folder and look at those while you're on the train or on an airplane or having dinner by yourself somewhere. Here's a good one, because if I were writing questions, this is what I absolutely would do. I would have you compute the required return on equity using one of the models that we just did, right? We went through all those examples. So question 1 is compute this. And then question 2 would be something like, okay, if one of these changes, then how does it impact and why? So that might be question 2 and 3. And then somewhere down there in question 4 or 5 or 6, I'm going to have some character in the vignette. Maybe it's Jenny, maybe it's Jerry, and Jenny or Jerry is going to make a comment. And let's suppose I asked you to do capital asset pricing model, right? And so I'm going to make a comment. Let's suppose I'm Jerry. And at the bottom of the vignette, it says, Jerry makes the following comment. Jerry says, hey, capital asset pricing model, this is a great model. We love it. It's a one-factor model, but I'm a little bit worried about its complexity. Do you disagree or agree with Jerry? And you would say, oh my gosh, absolutely not. We don't think Jerry, he doesn't know anything, right? So it's more complex. So if you have this picture, you can look through the strengths and the weaknesses and just memorize those and be ready for that kind of a question. All right, let's move towards the end of these LOSs in which we're moving on to a global environment. So you think about what's happening here. I'm Jim. I'm just a regular investor, and I own shares of Coca-Cola and Harley-Davidson and Johnson & Johnson. But I also hold shares of Nestle or Blaupunkt or somebody over in the German stock market. Well, what can I do? I mean, I can generate lots of dividends if I have equity securities. I can generate lots of coupons if they're fixed income securities, but we're focused here on equities. So I can get those dividends in another currency, and then I could change them back into dollars. I could repatriate them back into US dollars, and maybe the exchange rate moves against me, and all I have is 8 cents. You know, I thought I had 100 euros over there in a dividend, and now I convert them. I'm looking at 8 cents, and I'm looking at this 8 cents, and I'm looking over there in Germany. I'm thinking, what happened? So look at that. Look at that first bullet point. Unhedged international investment exposes the investor to exchange rate risk. So what that does, that extra currency or exchange rate risk, it adds volatility. And so we need to just scratch our heads and say, okay, do we really want that volatility or do we not? And the answer is probably not. So let's just use a forward contract. That's the super easiest way to do it. And there are other derivatives to do this. Now, comma, let me do a comma here. We may want to add that volatility because investing in this foreign company is one asset. But if we leave that position unhedged, we're coupling that investment with one in the currency as well. So we're betting on that foreign company to do really well, and then we're betting on the currency to move in our favor to lever those returns. So, of course, the required return on equity, we have to adjust it for our expectations on exchange rates. That's why lots and lots of executives have degrees in economics, or they hire consultants who have PhDs in economics to give estimates for exchange rates. Now, a couple of issues, of course, as they apply to emerging markets. Let me just go back here quickly. You know, this is probably an okay thing to do with Germany and other developed countries. But when you get into emerging markets and frontier markets, look at that first circle point. Difficult to estimate. Of course, it's difficult to estimate. But you can use a country spread model. You can use a country risk rating model. And these are available out there for a fee, of course, or we can develop our own models. So let's go ahead and just work through this just quickly here. The developed market as a benchmark and then add a premium. All right, so our equity risk premium for a developed country, and then we just add a country premium, which depends on things like, well, economic risk inside of that emerging market, political risk inside of that emerging market, the legal and regulatory issues inside that emerging market, the climate change issues inside that emerging market. Now we can use a rating model where we get out our Yahoo Finance and use our Excel spreadsheet to use some regression techniques to be able to come up with this country premium as well. This is the super simplest of all slides that I could give you here. Weighted average cost of capital. Remember what this is. On the right-hand side of the balance sheet, you have bondholders and shareholders providing capital to the executives of a company so that they can invest in positive net present value projects. We learned all this back in our Modigliani and Miller reading and a couple of subsequent readings, right? So what we're interested in, if the bondholders charge us 6% and the shareholders charge us 8%, then we need to take a weighted average. Is our appropriate discount rate, is it 6? Is it 10? And the answer is no. It's a weighted average of those two. And of course, we need to adjust our weighted average cost of capital with the tax rate, because the coupon payments, which are the interest payments on the bonds, those show up on the income statement and they provide us with a tax subsidy. So there's the equation. I bet you've seen that 1,000 times. At least I hope you've seen that 1,000 times. What we've put in red there are the capital structure weights. And those are market values, by the way, not book values. The RD and the RE, those are just the required return on debt, which is the yield to maturity on the bond for bonds that are outstanding. That required return on equity, well, boy, that's probably from capital asset pricing model or the Fama French model or any of these other models. And then we just weight all those. And so I think we have an example here. There's an example. Oh, here, this slide makes certain that you don't make some mistakes on the exam. Make sure you use the marginal tax rate, not the effective tax rate, because the effective tax rate includes things like non-recurring items and natural disasters that probably don't occur but once every 10 or 20 years. Make sure you use marginal tax rate, and then make sure that you use the target weights for capital structure if they are available. So what did I say back here? In those capital structure weights, those are market values, but sometimes target weights are different than those market value weights. So make sure you use the target weights. And that's what this example does here. Tells you about gives you book value and it gives you market value. So ignore book value and you put all those things together and you can do the math there quickly. You get 4.27%. Here's a really good LOS. I wish I could give you a really, really great example and a great answer to this. Evaluate the appropriateness of using a particular rate of return as a discount rate. I'd love to be able to say to you, hey, when this happens, then use this rate. Now, we can do that in general terms, but there's always an extra variable thrown in that makes us scratch our heads. All right, so are you ready for this? When discounting cash flows, analysts should use the discount rate that is consistent with the type of cash flow being discounted. All right, that makes perfect sense, that whatever we have in the numerator, then the interest rate or the discount rate in the denominator ought to be a reflection of the riskiness or the uncertainty of those cash flows. All right, so cost of equity, that should be used to discount cash flow to equity. That makes more sense, right? Nominal discount rates used to discount nominal cash flows. Weighted average cost of capital used to discount the cash flows to the firm. So that's important there. So look at cost of equity, cash flow to equity, weighted average cost of capital, cash flows to the firm. Real discount rate used to discount real cash flows. I don't have anything interesting to say about column 2 and about column 4, other than to make sure that when you get to the vignette that you read it very carefully and see the words nominal somewhere in there or the words real in there somewhere. And the Institute will probably make you link those cash flows to either a nominal or a real discount rate. And that takes us through this super exciting reading for me. That was a lot of fun for me. If I'm making up questions, I'm going to make up 2 questions. I'm going to make up one based on that first LOS with a bunch of returns, and then I'm going to do the third LOS with a bunch of those models, and then add in the other ones to fill in the questions in that vignette.